Ladies and gentlemen, hello. My name is Christopher Aaron. This is the iGold Advisor channel. It's February 3rd, 2016, and we have some new patterns that are forming in silver especially. We're going to be looking at that today. We are going to be looking at the inverse of that, which is some of the problems we're seeing in the financial sector. So we'll be getting into all that today. My goal is just to bring you the clearest analysis of what is actually happening in the markets, to try to filter through a little bit of the hype that we see sometimes from either side of the extreme standpoint, and just to show it to you in the actual raw data which appears in the charts. Thank you for being with me. If there's anyone who missed my announcement last time, I'm just going to say very briefly that I'll be starting a new channel within the next week, and that's going to focus on some of the more aggressive styles of investing that I do in the mining sector and some short-term trading. You will see a link to the research, which is free, which is an introduction to that, in the box below, and I would like you to read that if that's something that you're interested in. For everyone else, this will maintain my long-term channel focusing on gold and silver in the physical form, which I believe is the most important thing for the long run. So let's look at it. What's happening in the world today related to gold? This news out of Reuters couple of days ago, very interesting. Germany, which still in this day has the second largest holding of gold in its central bank, is repatriating 200 tons of its gold from the United States, which is being held by the Federal Reserve in the United States for Germany. They are taking it back into their possession within the borders of Germany. Now, the history of Germany in relation to gold is a fascinating subtopic in and of its own, perhaps a discussion for another day, as we know that Germany had a massive hyperinflation less than 100 years ago, so that knowledge has been passed down for the last few generations, so they place a high premium on gold. But it's just interesting to see here that Germany, the central bank of Germany, is distrusting the Fed, right? Why else would they take their gold back from within the country? So this is an interesting data point. I bring this to your attention to say, for those people who think that the entire gold market is manipulated by some massive central conspiracy, I disagree with you. Is there some manipulation in the market? Absolutely. There's manipulation in most markets that we don't know about. But for example, the idea that there is one central conspiracy between the central banks trying to suppress the price of gold. We have pretty strong indications here that the central banks of the world are not working in unison. Why else would Germany want to take gold away from the Fed? It's an interesting data point. And we look at this in respect to a lot of the other news items happening. For example, problems in the financial sector of the United States. We're looking at Citibank, or as it's been recalled, Citigroup. This is a 1.5-year chart of the stock price of Citigroup. And we can see here in the last few months, roughly a 30% decline in the stock of Citigroup. So something ugly is brewing in this company at the same time as Germany is taking its gold back. So there's a lot of cross currents here happening in the markets. Now, to put this in perspective, look at when the Fed announced its rate hike. right here in the middle of December. So we can see the vast majority of this decline in Citibank has happened since the Fed announced that they're going to raise interest rates from just 0 to 1/4%. Now, 1/4% is nothing in the grand scheme of things. We'll look at that later. But look how sensitive Citibank was to that rise. Why? Because Citibank has been propped alive by borrowing money at 0% and then loaning it out at some fraction of 1%. And so as soon as the Fed raised its interest rate, we see this has taken a serious toll on the equity, the projected equity at any rate, of Citibank. Now, let's back this chart out. We're looking at the same chart of Citibank, a 10-year time horizon. The last chart that we were looking at was right here in this red box. So look at the just tremendous decline that Citibank suffered during the crash of 2008, 2009, and then barely a recovery whatsoever. And keep in mind, Citibank is one of the primary institutions that owns stock in the Federal Reserve. So if the Fed was all powerful, if the central banks of the world were all powerful, they would have been able to stop this decline from happening. They have been unable to do that. So it's a very interesting place that we find ourselves in here as we look at the relative comparison of the major world commodities since that Fed rate hike in mid-December. We looked at this at 3 days, we looked at this at 2 weeks, we looked at this at about a month, and now we're at a month and a half. Gold, silver, and U.S. bonds, flight to safety, assets. The world is looking for safety after the Fed decided to raise interest rates by just 1/4%, and the world has been moving away from risk assets. Interestingly, the U.S. dollar has fallen here over the last week or so. The U.S. dollar is traditionally viewed as the ultimate safe haven. In 2008, during the crash, even in the short run, when silver and gold were falling, the U.S. dollar was rising. So something interestingly different is happening here over the short run, and I continue to note the relative strength of the precious metals, which should be an encouraging sign for anyone out there who has a long-term perspective. Looking at the cycle of Fed interest rate hikes, for example, we are seeing that from the post-World War II period, we were in a cycle of rising interest rates, corresponding with the peak in gold and silver at $8.50 and $50 per ounce respectively, followed by a generation of falling interest rates. And what have we seen? So this one fraction of a percent rise, and we've seen such a drop in certain stocks like Citigroup. It's not just Citigroup, Deutsche Bank, Bank of America, significantly impacted by this small rise. So what I'm saying is the Federal Reserve is caught between a rock and a hard place right now. The group is not all powerful. We have had 3 central banks in the history of the United States. The first 2 failed. This third one that we've had seems to be lasting longer than the first 2, but I believe it will ultimately fail as well. So they're caught right now because they've only raised interest rates 1/4%, and we've seen this weakness in the financial sector. What if they continue? How much weaker? Are they going to keep raising interest rates until Citibank and some of their other member banks go under? No, of course not. However, if they back off at this point after just a small rate increase, that will be the first time in the history of the organization that they back off after such a small increase. It'll be unprecedented. And I'm saying that I believe that will cause a more significant decline in the stock market than if they keep rising, if they keep raising these interest rates. Why? Because it'll be sending a signal to the market, wow, we didn't know what we were doing. We made a mistake. If you were to see this rise 1/4 or 0.5% and then plummet back down, the market would say the Fed has no idea what it's doing right now, which ultimately is absolutely part of the truth. We turn to look at the gold action as we always do. A very nice close today, above 1140 and holding above that as we get into the overnight trading in Sydney and Hong Kong Thursday morning there. We look at this from the 6-month perspective. It's always important to keep a watchful eye on multiple time horizons. If you ever see anyone show you a chart from 1 year or 5 years, you might want to say, well, what does that chart look like from 30 years? Or what does that look like from 6 months? So I try my best to show as many perspectives as possible because we get different information from each. So gold moving in this nice, well-defined uptrend now, the short-term uptrend after this recent low that we've seen. And in fact, just closing right above it today, this of course being the GLD fund. I don't recommend that you own the GLD fund except if you like to do short-term trading. So closing right above the upper end of this trend line, I would think that actually gold is going to take a pause here over the next few days to a week and come back into the middle of this uptrend range. I don't like to see when a new uptrend is just taken out to the upside like that because it indicates a market that's just getting too much hot buying all at once. And that hot buying tends to not be sustainable. So I'd prefer to see a slow and sustained rise than a spike up from a long-term investor perspective. Looking at the gold miners, very important break of this multi-year downtrend that I've been bringing to your attention for some time. And the other important thing to note about this is look here at the percentage gain of the gold miners. Over 7% rise today as gold rose about 2.5%. So that's a threefold move over the price of gold. And that's exactly what we should expect, what we should hope for if we are investing in the companies that dig the metal out of the ground. Now, the point that I want to make for people who watch this channel and who are stackers, and I am one of those, and the investment mechanisms that I choose, such as stacking metal and such as making investments in the mining sector and some short-term trades, they're not mutually exclusive. So I just wanted to say that as I sometimes focus on this action, and I'll be moving some of that to the other channel when I get really in depth. But I just wanted to say that for you so you know that I participate in this market in a lot of different ways, and I believe each individual has the right to do that in whatever way is best to them. So for those people who are looking to be more aggressive, this is an example of the reason why. You can have a massive outperformance in some of the better mining companies if you choose them at the right time and if they're the right companies. We look at gold over the 2-year time frame, seeing that short-term rise here that we were looking at, nicely well-defined in the teal color. We have a lot of colors and a lot of lines going on in this chart. So for anyone that's new looking at my charting system, I try to do this so that it makes as much sense, so that it draws your eyes to the important points here. The most important point being that we are still in this gently sloping primary downtrend, even within a short-term uptrend. And we will need to see this level taken out right around 1220 right now, which is coming down. So a couple months from now might be closer to 1200. We need to see that level taken out before we have a very strong signal that this was the final low. So does that mean you shouldn't buy any gold now whatsoever? No. But it also means you should perhaps buy some now and continue to anticipate that there may be some back and forth movement within this channel until we're proven otherwise. No one, including myself, has the absolute crystal ball. I say that right now. All that I have is a system that makes things clear for me, and I hope that it makes things a little bit more clear for you. So we're watching that right now. We want to see this level taken out before we have a very strong indication that we're in the next cycle rise. Just a quick check on those gold miners. You can see by the bouncing red ball here, that break. This has been a multi-year bottoming wedge in the gold mining complex that has just broken. So in the next week or so, we'll start looking in the new channel, the sub-channel. We'll start looking at some targets for this, how I expect this to break and advance. For right now, though, if you are looking at this, remember this chart in your mind, because this looks very similar to the pattern that silver is forming, this multi-year wedge pattern. And we're getting a leading indicator here from the gold mining sector. This will look similar to the breakout I expect to see in silver at some point in the next couple weeks to couple months. Looking at gold from the 7-year time frame, we were just looking at that primary decline that we're in within a larger term decline that in and of itself represents a retest of the former 1980 high. A very bullish pattern if this breaks above the primary trend anywhere above $850 per ounce. Silver, the more volatile of the two precious metals, finishing nicely today, back a little bit from its highs above the former level we were watching, that $14.50 level. It had some trouble breaking above over the last week or so. So looking at that, here was that black line. We were looking at this as the level holding silver back. This, of course, being the SLV fund. So this black line here that shows at 1390, 1395. This represented that $14.50 on the actual silver spot price. So we are closing today right above that level, just right above it. So obviously I want to see this level hold to have a sense that this break above 1450 is for real. Looking at our silver miner of choice, Silver Wheaton, one of the stronger silver companies, we are seeing that break above that short-term downtrend. Very nice to see that if you're a silver investor. Nice early indication signal. So going back, if you were to watch about 2 weeks ago, we were talking about Silver Wheaton here having this break below the summer lows. I was trying to understand the message of the market. I don't try to tell the market what to do. I try to let the market tell me what it is doing. And I was saying, I wondered, one of the possibilities here, was this a capitulation low? Was this the final washout before we get a springboard effect? By breaking through this downtrend here, that's looking increasingly likely. We'll have some other targets, some more medium range targets that we look for on Silver Wheaton, perhaps later on, or perhaps on the other channel. So here's that silver chart now from 3 years. And here's two things. One, why I'm excited to see this pattern, and two, why I want to hold a little reservation at the same time. Because we've had multiple hits on this downtrend line, right? The last one came in October. It was a false break above this line, which led to a quick $2 drop back down below when this break did not sustain. So we saw that break in this very similar looking pattern in the GDX, in the mining complex, from about 3 or 4 slides ago. And we'll be looking for a similar break here in the silver pattern, but it's not confirmed yet. Yes, it was good to take out this resistance at 1450, a very nice indicator that this was a medium-term bottom here, right around 1380, 1375. But the silver market has not broken out of its bottoming wedge pattern, which is why I maintain the possibility that if it does not break out now, it may retreat back again for the next several months into the lower part of this wedge, or worst case scenario, into the primary wedge that silver finds itself in, which still includes the possibility for $12 silver. So I'm not making this video to tell you silver is going to $100 in 2016. I'm making this video to tell you we have some nice, strong early indicator signals. This market is starting to pick up momentum. It's starting to show that it's looking for its long-term bottom, and those signals are getting stronger. And this is getting fairly interesting to watch now, but we want to really watch it to be sure. So thank you for staying with me as we look at that bottoming signal from the multi-decade time frame that will eventually exceed $50 as my thesis for the next 5 years. Summary, we've pretty much covered everything. Gold is in the short-term uptrend. We're seeing the major breakout early signal from the mining complex. Talk a lot about those later. Silver's line in the sand is $15 still. If it doesn't break that now, let's see. Do we get down to 12? That's the possibility. It's been wonderful to have you all here. Enjoy the rest of your Wednesday evening or Thursday morning if you're in Europe or Asia, and I will see you this weekend. Thank you.